cracks in the system are widening and the whole world is watching closely. China is no longer acting quietly in the background. It is taking calculated steps that strike directly at the heart of American financial dominance. For decades, Washington has operated under the assumption that the dollar would always remain at the center of global trade and security uncontested. Today, that certainty is disappearing. Beijing is gradually reducing its holdings of U.S. Treasuries, accumulating vast reserves of gold, and building alliances with states tired of living under American rules. These are not abstract plans on paper, these are already actions reshaping global finance. Behind closed doors, policymakers are scrambling to find solutions. Investors are shifting their capital while ordinary citizens know almost nothing, even as the global chessboard changes before their eyes. Every move by Beijing resonates in stock markets, corporate boardrooms, and household budgets, affecting savings, jobs, and the cost of living. Treating this as just another trade dispute underestimates the scale. This is a struggle for financial power, and for now, the advantage is on China's side. Looking closer, China has been gradually reducing its investments in U.S. Treasuries for several years, and the pace is striking. In July, its portfolio fell to roughly $730 billion, a decline of $26 billion in just 1 month. This is the lowest level since 2009. By comparison, in 2013, China held nearly $1,300 billion. In just a decade, its holdings have nearly halved. Such decisions are never taken lightly. Selling hundreds of billions is a long-term strategy. U.S. Treasuries are the heart of America's financial system. They are government bonds that finance public spending and uphold the dollar as the world's most reliable currency. But this reliability depends on steady demand from major foreign buyers. When they withdraw, confidence in this pillar begins to crumble. The bigger picture is troubling. U.S. public debt has already surpassed $37 trillion and continues to grow daily. Servicing this mountain of debt requires a constant influx of foreign capital. But China is withdrawing. Japan is also reducing its holdings, and Middle Eastern countries are increasingly transacting in yuan. Each of these moves increases tension in the U.S. bond market. If foreign demand dries up, the burden will fall on domestic banks or the Federal Reserve itself. In effect, the U.S. will be borrowing from itself, which means higher interest rates, greater inflationary pressure, and weakened confidence in the dollar. The question is clear. If fewer and fewer countries are willing to finance Washington's debt, who will fill the gap? And if this flow cannot be replaced, how long can the U.S. continue at this pace without serious consequences? These are not abstract debates. They affect mortgage rates, retirement savings, and the prices of goods in stores. To understand this trend, one must consider China's motives. Its withdrawal from U.S. Treasuries is not about short-term gains, but long-term survival. Chinese policymakers have warned for years that the dollar is not just a currency, it can be used as a weapon. This became painfully clear in 2022 when Washington froze Russia's foreign reserves after the start of the war in Ukraine. Hundreds of billions that Moscow considered secure became instantly inaccessible. For the United States, this was a punishment. For Beijing, this is a loud warning. Chinese leaders envisioned a scenario. What if a conflict over Taiwan erupts and nearly $1 trillion U.S. assets are frozen? The risk is too high. The response has been gradual but deliberate. Beijing began reducing its holdings in treasuries and redirecting reserves into assets beyond Washington's control. Gold became the center of this strategy. Unlike dollar-denominated assets, it cannot be frozen by sanctions or blocked through banks. By gradually increasing gold reserves, China is building protection against U.S. financial pressure. At the same time, part of the funds is being allocated to other currencies, the euro, the pound, and the Swiss franc. These are also liquid, but less dependent on Washington's decisions. For the United States, this shift is happening at a moment of maximum vulnerability. With a national debt exceeding $37 trillion, America relies on global demand to keep borrowing costs manageable. If major foreign holders withdraw, Washington becomes dependent on domestic banks and the Federal Reserve, which means higher interest rates on debt, additional money printing, and increased expenses for every household. The first signs of this pressure are already visible. Treasury auctions require offering higher yields to attract buyers. Inflation remains above the level acceptable to the Fed. Meanwhile, the BRICS bloc is building new trading systems that bypass the dollar entirely. Step by step, the global financial order is adjusting to a reality in which treasuries and the dollar no longer occupy an undisputed central position. While Wall Street celebrates new records, the real economy tells a different story. The labor market, once a reliable pillar, is starting to falter. In August, the U.S. added only 22,000 jobs, far below expectations. The unemployment rate rose to 4.3%, the highest since late 2021. Previous month's figures were also revised down. June, for example, shifted from reported growth to a decline of 13,000. Large sectors such as manufacturing, construction, and professional services are already cutting jobs. These are clear signals of a broad slowdown. If this trend continues, the economic impact will be swift. Hiring delays and rising layoffs always reduce consumer spending, the foundation of the U.S. economy. Financial leaders are already expressing concern. Larry Fink, CEO of BlackRock, stated plainly that the economy is weakening before our eyes, pointing to declines across multiple sectors and falling consumer demand. Jamie Dimon, CEO of J.P. Morgan, was equally blunt, assessing the odds of a recession at 50-50 and warning about risks in the private credit market, where high debt makes the system more fragile. Recent figures confirm their warnings. In the first quarter of 2025, the economy unexpectedly contracted by 0.3%, the first decline since 2022. The OECD forecasts that U.S. growth will slow to 1.8%, 8% in 2025, and 1.5% in 2026, citing tariffs, weakening global demand, and tightening financial conditions. Yet, on the surface, markets still appear unstoppable. The S&P 500 broke 25 records in just 3 months, and annualized returns are already in double digits. But this euphoria rests on fragile foundations. The key contradiction is that stock markets are rising while the real fundamentals underneath are deteriorating. Investors are betting that weak economic data will force the Fed to cut rates. And these expectations are sustaining high valuations. But if inflation does not fall, if layoffs intensify, or if corporate profits decline, these expectations could unravel rapidly. Cracks in the U.S. economy are already evident, and Beijing is watching closely. By reducing exposure to U.S. debt, China is not leaving its funds idle. It is redirecting reserves to Europe, where the financial system combines scale and stability. The euro is the second most important currency in global reserves, and the EU remains China's largest trading partner. According to Eurote, in 2023, trade amounted to nearly 860 billion. It makes sense that Beijing holds more euros in its reserves rather than relying so heavily on the dollar. The United Kingdom plays a different role. Even after Brexit, London has retained its status as one of the most influential financial centers. Chinese banks and tech companies still use it as a gateway to European markets. Earlier this year, the London Stock Exchange expanded the Shanghai London Stock Connect program, giving Chinese companies direct access to the UK capital market. For China, the pound is a smaller portion of its reserves than the euro, but it adds another layer of diversification and a bridge to Western markets. And of course, Switzerland is a country whose reputation far exceeds its size. The Swiss franc has long been considered a classic safe haven currency, attracting investors during any market turbulence. Even in 2024, when the franc reached lows not seen for years, global capital continued to flow into Swiss assets. The reasons are simple. The cautious policy of the national bank, a stable and neutral stance, and a reliable banking system. For China, investing in francs is not about profit, but about protection against shocks, both market and geopolitical, by placing reserves in euros, pounds, and francs. Beijing not only reduces risks, but also sends a signal to the world. U.S. Treasuries are no longer the only reliable option for global reserves. The shift in perception could be as important as the actual flow of money. Once other countries start believing that the dollar can be replaced, the old financial order will begin to wobble. Cracks are already spreading and confidence is leaking. Auction after auction. Once faith in treasuries weakens, the dominance of the dollar could fall with it. History shows that global power never waits for someone else to catch up. Think about it. If the pillars of American financial strength are shaken, what will the next global reserve system look like? And who will control it? Stay tuned. The next chapter of this story may arrive faster than anyone expects.